Okay, hello everybody, and welcome to Module 3. Today we're going to be talking a little bit about profitability analysis and interpretation. We're going to be taking a deep dive into return on equity and the components that make up that return on equity calculation. And as it applies to your semester-long research project, this will be one of the modules that you'll be required to go into a little bit of a greater detail. It's important that we understand the components of return on equity for the companies that you've selected, and this will give everybody in the class a nice opportunity to work on that together. So let's dive in and talk a little bit about ROE. Okay. Our first learning objective in Module 3 is to compute and interpret ROE. Here's the calculation, as you're probably aware of it from your finance prerequisite, or maybe even your accounting prerequisite. You should be familiar with terms like net income and average stockholders' equity. Again, as a reminder, if you struggled at all with Modules 1 or Modules 2, seek help. The Block School has tutors available and online resources. Those materials and even Module 3's materials are really meant to be a review of the prereqs. So if you're struggling, get help sooner rather than later, because it's going to get very technical very quickly in this class. So net income divided by average stockholders' equity. Net income is at the bottom of our profit and loss statement, reported on our statement of shareholders' earnings. Average stockholders' equity is going to be on our balance sheet, and then each of these is going to be comprised of a group of subcomponents. Here you can see here Intel's return on equity calculation, really very simple. Should have no problems finding sales, net income, assets, total stockholders' equity. Now, pay attention here to the denominator. We have net income in the numerator of, well, it looks like 11,420,000,000 divided by average stockholders' equity in the 2 years there, ending 14 and 15 at 55 billion and 61 billion for an average of 57 or 58 something, equals a return on equity of 19.53%. Now in that denominator, you're going to notice that we're taking an average, but you will also see this calculated as just an ending number. It's not uncommon for analysts to take net income and simply divide that into ending stockholders' equity. Just know that's a shortcut and not technically right, but it's also common. So don't get tripped up over that. And if a company's financial affairs haven't changed that significant, it'll still produce meaningful and actionable numbers. But for the purposes of this class, and for the purposes of the exam, make sure that you're using average in the denominator. And then also, if you get tripped up on the homework, I've already caught the authors doing this a couple of times in the few of the homework questions. They'll forget to take that average, or they'll just use a simple shortcutted method in that denominator, meaning end of period data, and it doesn't always show up in the form of end of period equity. It might be end of period assets or end of period liabilities, depending on the ratio that we're trying to calculate. Okay, now we're going to take that return on equity number and we're going to apply something called a DuPont method of disaggregation. I suspect you've probably stumbled on this before in one of your finance classes, so this may be a review. DuPont is the name of the professor that came up with this analysis, and I forget where he was stationed out of. But we're going to take the return on equity and we're going to break it down into two core components. We're going to break it down into the return that comes from the basic operating functions of the business, and then there's a secondary return, or what we're going to call a leveraged multiplier, where we can accelerate that return on equity by introducing a level of debt to the company's operations. So let's look at the formula here. ROE in this instance equals the same net income divided by average stockholders' equity that we just reviewed, which in turn equals net income divided by average total assets or return on assets, times average total assets divided by average stockholders' equity, or basically the percentage of your total company that equity allows for, which we call a financial leverage component. When we multiply these two ratios together, we'll get return on equity. So in this instance, ROE reflects both the company's performance, which you can think of as how much of a return that company would generate independent of any financing decisions. So whether or not we have any debt on the balance sheet is independent to this calculation. And then secondly, how that company has financed its assets over time. So you'll see as we go through this that the level of ROE is higher when we add more debt to a company and lower when we add less debt. And it's important to consider that when you're analyzing your companies for your research project. How much debt does the company have? Is that debt sustainable? What effects does it have on a company's ROE? What effects does it have relative to its competition? So maybe your company is in an industry or a peer group where the industry or peers have more debt than the company that you're doing your research project on does. Be able to explain that. Why has your management team chosen to have more or less debt? And then what I really want you to get at in your research projects is, do you agree with that? Is it appropriate? Do they have debt for the right reason? Are they using that debt to finance a growth strategy that's reasonable, rational, believable? These are the types of questions that I expect you to be able to answer in your research project. And they're not easy to get at. It takes a lot of work to analyze the company at that level, to find all of the materials, the source materials, and the commentary to make those assessments accurately and defensively. Return on assets, as I mentioned, is a measure of how well the company is operating. We're going to use the profitability number in the numerator, and again, average total company assets in the denominator. And I can move through many of these slides quickly because they should be a review. So you can feel free to come back, spend a little time with these. If you do have questions aside from what I've been able to present here in Module 3, feel free to reach out. Or again, a reminder just to get review help if you're confused at this point in the class. The financial leverage component, liabilities, or rather assets over average stockholders' equity, is going to give us the percentage of that company that's actually financed by owner equity. And then we're going to start to layer in some nuances to this equation when we see balance sheets that have more complicated financial structures. So in this instance, our authors are giving us a little bit of information on how that formula would be adjusted if we have preferred stock on our balance sheet. So we have return on common equity in this instance, where we're going to take our net income in the numerator and subtract out preferred dividends. As a review, preferred stock is simply another means of financing a publicly traded company, whereby we'll give certain shareholders a senior preference in the capital structure. And that senior preference typically comes with a variety of rights, privileges, obligations, and responsibilities. So the preferred shareholders will typically be able to participate in some of the upside growth of the company, but they're also protected in a bankruptcy situation. But they don't get full participation in the upside of the company, which is why the common equity still has a preference for many shareholders. And voting rights may or may not be accompanied with that. Preferred shares are really the wild, wild west of equity ownership, because they can be written according to any legal agreement. You really need to dive into the prospectus to understand what, as a preferred shareholder, your rights are, what you're entitled to, and what covenants are associated with that. So if you have a significant portion of preferred shares on your company's balance sheet, take a look at those and be able to explain why your management team has chosen to finance its company with preferred shares, and whether or not that might represent an opportunity for different investors with different risk tolerances. Then in the denominator, we see average stockholders' equity, and again, we're going to subtract out the average preferred equity. So for most of you, the preferred stock simply won't represent a large enough asset class to worry about when you're writing your research reports, but it may show up on the exam, so you need to be familiar with this formula. So let's take a look at return on assets, which can similarly be disaggregated into profit margin times asset turnover. Profit margin here is net income divided by sales, simple enough. Asset turnover is sales divided by average total assets. So think about that as how many dollars worth of sales does each dollar's worth of assets generate? And then be familiar with what that ratio is across your industry, across your peer group, and be able to explain why the company that you're looking at might be greater than or less than its peers. So if you're analyzing Kansas City Southern Railroad, compare that to Union Pacific, compare that to Canadian National, and what is it about your peer group and their business models that cause that ratio to be different. Those two numbers in turn multiply together to get return on assets. So that's one of the components of our ROE breakdown. This is a great little graphic. It shows the total disaggregation of ROE into the two ratios that we just looked at, return on assets and financial leverage. And then return on assets can be broken down into its subcomponents, profitability and productivity. And then we have various ways of measuring productivity. We have accounts receivable turnover, inventory turnover, accounts payable turnover. So just like we looked at asset turnover a moment ago, we can look at each subcomponent of our asset section of our balance sheet, accounts receivable, inventory, payable. All of these three turnover ratios help us to calculate a cash conversion cycle. And then lastly, property, plant, and equipment turnover. And each of these yield various insights into how well or not well, as the case may be, our management teams are managing the companies that we're looking at, and relative to peer groups and industry classifications there again. So let's look at some of these ratios one by one. Gross profit margin is going to be our top line sales number, so independent of any sales returns and allowances or anything else like that that might be a negative against top line sales. Operating margin expense, if you think about the income statement, we're really just going down one line at a time and taking each of the line items against total sales. So we can see what percentage each of these components are of the income statement. Cash conversion cycle, I mentioned just a moment ago. Be familiar with these ratios, with these numbers. Days sales outstanding, we're going to take 365 times average accounts receivable divided by sales. And we're going to do the same thing with inventory, only we're going to use cost of goods sales in the denominator. We're going to take accounts payable, use cost of goods sales in the denominator. And then our cash conversion cycle equals our accounts receivable days plus our inventory days minus our accounts payable days. And that gives us some indication of how quickly or slowly we're taking cash, pushing it through our inventory cycle, collecting that cash, and turning it back into profits or retained earnings that we can, again, reinvest into the company. So generally, we're going to prefer a lower cash conversion cycle. Some companies are managed so well, or they just have such a strong competitive advantage against their kind of industry group. If you look back to, I think it was Module 2, we touched on Porter's 5 Forces. And if a company's in a particularly strong competitive position, they may have a negative cash conversion cycle, meaning that, take Apple for instance. It's not uncommon for Apple's suppliers to fund their inventory, meaning that they will give Apple the equipment that they need to manufacture iPhones and then require payment 60, 90, 120 days later. That allows Apple to manufacture these, get them on the store shelves, collect money from customers, and they're cash flush without ever having to pay their suppliers. And that creates a negative cash conversion cycle, which is a terrific way to finance your business. And if any of your companies are in a negative cash conversion cycle, definitely highlight that in your report. Be able to explain it, understand why it exists, and then draw that out in light of those Porter's five forces too, and just highlight the bargaining power that your company might have against its peer group, because typically that's a very sizable competitive advantage that you're going to want to draw out in any presentation. I got a little ahead of myself there. Apple's negative cash conversion cycle is shown on slide 16 here, where you have days sales outstanding, days inventory outstanding, and days payable outstanding footing or summing to a negative cash conversion cycle of 52.7. And here, like a lot of the things that Apple does, this is very, very impressive. Now let's contrast that to a company like Merck, where we see that rather than being negative, they had in the last 3 years they've had 155, 134, 123. This is trend analysis. We can see that that's definitely moving in the right direction. And if you look at the subcomponents, where they really seem to have made the progress is in this days inventory outstanding. So Merck's getting more efficient at managing its total inventory. Now, why is that? That's the question that you need to be asking yourself as an analyst. And maybe that's a question for Merck's management team, or if you've already gone to Thomson Reuters and downloaded a lot of the research reports, that might have been highlighted already from one of the analysts. Grab that, put it into your research report, be able to explain it, and be able to explain it against their peers too. Property, plant, and equipment. Another one of the ratios that foots to productivity. We're looking for more dollars worth of sales generated from each dollar's worth of property, plant, and equipment that we have invested and reported on the balance sheet. So what we like to see are companies that can drive a tremendous amount of sales from very little property, plant, and equipment. That's going to lend itself to higher profitability, higher return on assets, higher return on invested capital, and is generally indicative of a company with a strong business model, a defensible business model, a competitive advantage, and all of those things are encapsulated in a term that we refer to as a moat. This was a term that was, I originally came across it when I was analyzing the works of Warren Buffett. He speaks about companies with a strong moat all the time, and you can think of that as a competitive advantage or something else that gives a company a defensible position when it comes to its return on assets and return on invested capital. Let's move into financial leverage. There's a couple of ratios that you need to be familiar with here. One is total liabilities to equity ratio. The second is times interest earned ratio. Let's see. We'll go into the breakout of these maybe a little bit later in the module, but some comments on each. The total liabilities to equity ratio is the most common measure of financial leverage. Definitely be aware of that for your companies that you'll be analyzing. It gives you some indication of how frequently and to what degree management has used debt to finance its business, and a little bit of debt's not a bad thing at all. A lot of debt will absolutely put stress on any business and should cause you as the analyst to hit the pause button and ask when and how exactly your management team plans to pay that back, to finance that, maybe to roll it over in the future, because it can cause severe problems, especially in an instance like 2007, 2008, where you had a liquidity crisis and companies across the S&P 500 had trouble finding means of financing for their operations. Okay, let's move into learning objective number 4 here, and identify balance sheet operating items and net operating assets. This is going to be an important section because we're going to use this term many times throughout the semester, this net operating asset terminology. It's going to be important for you to know and understand in modules 6, 7, 8 later in the semester. So you might just flag this or star this or highlight it or something so that it's easy to come back to, because I've found in prior classes that students tend to get a little bit confused with these terms. Our authors, and all authors for that matter, take a little bit of liberty with some of the terms that we use in the field of finance, and that's okay, because while accounting is very discreetly defined and governed by a set of rules that we call generally accepted accounting practices, finance is not. And a lot of these terms can be defined differently by different authors. We're going to use the terms as defined by our authors. So just flag this and be able to come back to it in the future. In this module, we're going to look at a separate analysis of ROE, where we break down ROE with, again, an operating focus. And let's dive into that here again. In this analysis, which is slightly different from the DuPont method, we're going to look at ROE as a ratio that breaks down between operating return and non-operating return. What do we mean by operating return? So think back to the DuPont analysis that we just went through, and we broke down ROE into return on assets and financial leverage. So financial leverage was defined by debt on the balance sheet. Well, this method that we're looking at now is similar but nuanced, because we look at operating versus non-operating assets. So let's look at an indication of that in these two bullet points down here. We have our accounts payable and accruals are interest-free and self-liquidating, meaning that they are paid when receivables are collected as a part of the cash conversion cycle. So those are operating assets. Borrowed money is interest-bearing and often contains several legal repercussions in the event of non-payment, possibly risking bankruptcy of the company. This is what we would think of as a non-operating asset. So that's the key distinction, is in whether or not these are core to the ongoing operation of the business. Now let's break those down. Operating returns are reflected in the return on net operating asset ratio, which is net operating profit after tax, what we're going to call NOPAT, divided by average net operating assets. Let's look at each of those in turn. So here's your cheat sheet. On slide 25, this is another one to star. You have current assets, current liabilities, long-term assets, long-term liabilities, and the operating assets are highlighted in red. So accounts receivable, inventories, prepaid expenses, deferred income taxes. These are not inclusive of all asset classes that you're going to see on every balance sheet. So it's important to understand the concepts behind this. If they're operating, meaning that the business can't operate without accounts receivable. The business can't operate without inventories. A business can't operate without prepaid expenses. Think some rent, some insurance, things like that. If you go through that thought process and think about whether or not a business can operate without that line item, then you're going to classify those core activities as operating and those non-core activities as non-operating. And you say, hey, wait a minute, what about cash and cash equivalents? Well, some minimum level of cash and cash equivalents is going to be operating. But the fact of the matter is that most businesses can run with almost zero cash in real time, hypothetically speaking. So the authors here classify those as non-operating assets. Here's Intel. We can take Intel's balance sheet and break it down between operating and non-operating, where you see basically the same asset class distinctions here in red versus the non-operating in black. And then we move on to learning objective 5, where we'll look at the same components of net operating profit after tax. Okay, net operating profit after tax. This one gets a little bit tricky when we get down into the after-tax section. But initially, when we start with revenues and cost of goods sold and gross profit and so on and so forth, those are all going to be net operating profit. Pretty self-explanatory. That takes us all the way down to operating income. And then we're going to have, typically we see interest expense, interest dividend, interest investment gains and losses underneath operating income. And those are not operating. That's why they're listed in black here. Gets us down to income from the equity method of investments, non-operating expenses. That's ought to be an easy one for everybody to classify as non-operating. Then we get down into tax expense. And that's going to cause us some challenges because tax expense is both operating and non-operating, as you can see from the red and black coloring of tax expense. Part of tax expense is payable to the state federal government on account of profits that we generate from operations, and that's great. But then there's also a tax shield that we get from the interest component that we subtract off of operating income. So if we don't have any non-operating items on our income statement, meaning we don't have any interest expense, we don't have any dividend revenue, we don't have any gains and losses, then this tax expense number is going to be 100% operating. But to the extent that we have some of these non-operating items detracting from our operating income, we're going to have a tax expense that's lower than it otherwise would have been. And we need to adjust for that to calculate accurate net operating profit after tax numbers, which allow us to compare across industry, across time, across peer groups, so on and so forth. And all of those numbers are again going to be very meaningful when we get into the analysis of each of our companies. So for Intel, this is what we're looking at. You can see that same calculation for years 13, 14, 15, down through operating income. Pretty simple stuff. Subtract off interest, subtract off gains from other investments. We get down here to the provision for taxes, and you can see that part of that tax expense is going to be operating, and part of that is going to be non-operating. Now, how do we figure out which part is operating and which part is non-operating? We'll use this nifty little formula here. Again, net operating profit after tax equals net operating profits before tax minus tax on operating profit. Tax on operating profit equals our tax expense as reported on the income statement plus our pre-tax net non-operating expense, so really just net not operating expense, so that interest expense and interest gains and so on and so forth, times our statutory tax rate. So this is called our tax shield, which, by definition, lowers the tax expense that we pay, and we want to be able to identify. So let's look at the calculation here. Assuming a 37% statutory tax rate, Intel's NOPAT is computed as follows. We take our net operating profit before tax of $14 billion, and then we're going to calculate our tax shield, basically, which is our tax expense from the income statement of $2.7 billion, plus our tax shield of 210 non-operating expenses times 37%, which equals $78 million. And that totals $2.7 billion, which will subtract from our net operating profit before tax to get our net operating profit after tax of $11.2 billion. Okay, moving on to Learning Objective 6, where we'll compute and interpret the return on net operating assets. We already calculated net operating assets, so let's look at that total ratio here again, where we'll take return on net operating assets equals net operating profit after tax divided by average net operating assets. So we know each of these components. We can plug Intel's numbers in for each one. Again, we're taking the average in the denominator, just be aware of that. And that equates to a 22.86% return on net operating assets. Now, what do we do with that number? So here's our return on net operating assets versus our return on operating assets. So we have quite the distinction here between what we calculated using the DuPont analysis versus what we calculated using an operating focus. We have basically the same net income number of 11.4 billion as we do a net operating profit after tax. Minor adjustment there for the non-operating portion of our tax expense. But where we get a significant deviation is between average assets of 97 billion for Intel versus average net operating assets of 49 billion for Intel. So there's nearly $50 billion worth of assets on Intel's balance sheet that we would classify as non-operating or not otherwise really core to the processing and manufacturing of the chips that they sell into the marketplace, which as an analyst really makes you think. If they can generate 22% return on net operating assets, but they're only actually returning 11.7% on total assets, what are they doing with those other $50 billion in assets? Is that a cash hoard that Intel has on their books that they've saved up for a rainy day? Are they tactically using those assets as potential merger and acquisition dry powder, if you will? These are other good questions for management, and we need to understand why they're running their business with so much fat, I guess, if you will, because there's a lot of assets that shareholders are not getting compensated for. We could take those assets, we could return them as dividends, we could deploy them in additional sales strategies, we could use them to fund M&A activity. What's the strategy for those assets? Because if they weren't there, if we just wrote a big check to shareholders and distributed them so that they were no longer on the balance sheet, well, the core assets could actually generate a 22% rate of return, which is a lot more attractive than an 11% rate of return. So these are the types of questions that I want everybody to be able to ask as they go through these ratios and draw distinctions and points of difference between return on average assets or return on assets, as we just broke down with the DuPont method, versus return on net operating assets, which is more of an operating focus. Okay, moving on to learning objective 7. Let's disaggregate return on net operating assets into its subcomponents of net operating profitability and net operating asset turnover. Now this should sound familiar because just like we disaggregated return on assets using the DuPont method, we're going to take those same components, only this time with an operating focus, and disaggregate return on net operating assets. So we have our formula here, NOPAT over average NOA. We're going to take NOPAT over sales and sales over average NOA. And we can move quickly through these because we already drew the distinction earlier in the module where we took Intel's balance sheet and we identified the red items as operating and the black items as non-operating. So we're basically going to use that same distinction here and plug those numbers into the same formulas that we used for the DuPont analysis. And that yields a net operating profit margin equal to net operating profit after tax, which was that 11.2 number that we calculated for Intel divided by total sales. 55 billion gives us a net operating profit margin of 20.39%. Doing the same thing for net operating asset turnover yields a 1.12 asset turnover ratio. So what affects each of these numbers? This is one of the core slides in the module. Anytime we get to the point where we're at the interpretation of a ratio, that's what this class is all about. Financial statement analysis is not about being able to plug numbers into formulas. Financial statement analysis is about understanding the formulas and understanding the output of those formulas. So we need to be smart enough, we need to have the wherewithal to recognize that our net operating profit margin is going to be affected by things like gross profit, by operating expenses, by the general level of competition in our industry. We need to recognize that net operating asset turnover can be either increased or decreased by our level of sales, by reducing operating working capital, by making our business more efficient. And then why? The answer to a lot of these questions is, rather the question that we need to be asking ourselves is, why is that? What is this business, what is this management team doing differently than some of its competition? And we can see here a nice graphic that our authors give us that highlights some of the differences between different industries that operate with greater or lesser degrees of profit margin and accounts receivable turnover and property, plant, and equipment. You know, you would expect a company like oil and gas extraction, which is heavy investment base, lots of property, plant, and equipment in that business, to have a different profit margin than pharmaceuticals, which are, you know, very high margin. You can see here the general relationship between net operating asset turnover. There again, asset turnover is how many dollars worth of sales does your business generate for each dollar's worth of assets, plotted against net operating profit margin. So there's a general loose indication between those two things, and you can kind of see where pharmaceuticals and biotech and food manufacturers fall on that scale. So aerospace and food manufacturers generating a lot of sales for each dollar's worth of assets, but not a particularly high level of profit margin on each of those sales. Learning objective number 8, moving into our appendix, compute and interpret non-operating return. And since we're in the appendix here, I'm going to move quickly and simply highlight a couple of slides, a couple of the graphics that I want you to be aware of, one of which is on slide number 42 here. This is a great little graphic that shows the breakdown of your non-operating return and its subcomponents. And again, we're back to financial leverage here. Just like with the DuPont analysis that we started with at the top of the module, we're going to break down the operating focus into financial leverage and another component called spread. You may see a homework question on that. You also may see a test question on that, but it's not going to be heavily testable material. So review that on your own time, and as appropriate, review some of these other examples that the authors give us. I did want to highlight, okay, liquidity and solvency. Just wanted to touch on liquidity and solvency and note that the current ratio and the quick ratio, both of these are good for identifying whether or not your business might be in any near-term trouble. As a creditor, as a shareholder, as an employee even, it's worthwhile to have, you know, some feel, some grasp, some recognition of what your company's current ratio is, what your company's quick ratio is, because it gives you an indication of their ability to pay off their near-term debts. So, for example, our current ratio equals current assets over current liabilities. If this is much less than 1, then you need to recognize that this business has more current liabilities than it does assets, which means that it has more debts that it owes than cash in the bank to pay those debts. And if it's not generating the cash on a weekly, monthly, quarterly basis, they may be in serious financial trouble in the short run. And you need to ask your management team about that. You need to inquire, need to understand that. What's their strategy? If that's less than 1, you know, preferably 1.5, 2, 2.5, 3 would be a much better ratio. Identify that for your company, identify that for its peer group, identify that for its industries, and understand the difference. So here's another ratio that we're gonna look at called the quick ratio, which backs out inventory, because inventory is not always readily convertible into cash. If you have a bunch of inventory, especially if it's been on the shelves for a while, it might be obsolete. Particularly if you're in the fashion and apparel industry, that inventory can decline in value very, very quickly. So we're going to look at something called the quick ratio, where our current assets are cash, marketable securities, and accounts receivable. Notice that there's no inventory in that equation. We'll take those 3 numbers and divide by current liabilities, and that gives us even a more conservative version of the current ratio, or more conservative analysis, you might say, of a company's liquidity concerns. Now, solvency analysis refers to a company's ability to meet its obligations, and there's a couple of approaches to looking at this. The first is that we're going to look at the balance sheet. The second, we're going to look at an income statement. Our first solvency ratio is liabilities to total equity ratio, and the distinction I want to make here is the difference between solvency and liquidity. A company can be solvent, meaning more assets than liabilities, without necessarily being liquid. This goes a little bit back to the ratios we just looked at between the quick ratio and the current ratio, where I made the distinction that inventory is not always necessarily liquid. Well, if a company doesn't have liquidity, it might not be able to meet its short-term needs. But even if a company does have liquidity, it may not have solvency if the ratio of liabilities to equity has just gotten too outsized for a company to sustain. So once this ratio starts to get much up over, well, it's different for different industries. You can see total liabilities to stockholders' equity for banks, as an example, at 10 to 1. That's not uncommon at all, which is one of the reasons why I excluded all banks from those companies eligible for our semester-long research project, because it takes that balance sheet and it makes their business models quite a little bit different from anything else that we're going to be looking at this semester, if you think in terms of just kind of conventional financial statement analysis. But conventionally, you see that number 2, 3, 4, 5 times, it's going to create some concerns. So you need to be familiar with and understand what an appropriate or conventional ratio is for your industry and be able to explain that. And the authors give us an example of that here, where we look at liabilities to equity in 2015 for a variety of different industries. And you can see that between 1 to 2 times, most industries are going to be under 2. We have agriculture implements as a little bit of an outlier there, and then restaurants as a pretty sizable outlier. Times interest earned ratio is another solvency ratio that gives us some indication of a company's ability to pay back its debt. So if you're a banker and you have a loan outstanding to a business, times interest earned might be particularly meaningful, because it's going to give you some indication of how able a company is to pay the interest on its loans. If you see here that earnings before interest and taxes are a multiple of interest expense, maybe 4, 5, 6 times, well, that doesn't create very much anxiety about a business's ability to pay its interest expense. So this is a number that's key to a lot of banking relationships. Okay, and then the last thing I want to touch on in Module 3 is something called vertical and horizontal analysis. So this is core to your research project. I want to see vertical and horizontal analysis of all financial statements associated with your company. And there's good examples here of Intel's balance sheet. So what we're going to do is we're going to take Intel's balance sheet and we're going to present that balance sheet as a percentage of assets and as a percentage of total liabilities and equity. So you can see here that the balance sheet stated in millions. It flows through columns 13, 14, and 15. We're going to take those numbers and we're going to divide each line item into total assets on the top half of the balance sheet. So we can see here that cash and cash equivalents has moved from 6% to 2.7% to 14.85% of total assets from years 13, 14, and 15. And what I'd like to see you do is go back at least 5 years and hopefully 10 years to show a good trend analysis of each of these. And then you're going to be able to identify any outliers. Just like we looked at the difference between the DuPont method and the operating focused method of disaggregating return on equity. Well, this vertical analysis, this horizontal analysis gives us some further insights. Because when you look at ROE for 2015 only, well, there was a big difference between the DuPont breakdown and the operating focus breakdown, and that might have been due to this outsized cash component. So then the question for an analyst becomes, well, what happened between 2014 and 2015 to create all that cash? And then, what's management's plan for deploying that cash? And if they have a good plan, it might create a much rosier picture of the future, and if you can understand that and gain a competitive edge, an insightful competitive edge versus some of the other analysts on Wall Street, Well, you can make a lot of money in the field of portfolio management by applying that in a disciplined fashion over time. So we look at each of those in trend series analysis across the balance sheet to, again, gain some insights about Intel. So here's our income statement. We're going to do the same thing with the income statement, only we're going to look at everything as a percentage of net revenue. So net revenue is also obviously going to be 100%. Then when we divide cost of sales into net revenue, we can see how cost of sales has trended for Intel over the past 3 years. We have that falling from 40 to 36 to 37. And we can just kind of eyeball each of these over time to see how the company is maintaining its efficiency or maybe struggling in different areas. And again, that's going to produce insights and questions and opportunities for analysis. And these can be very insightful reports. So plan on generating those for your target companies. And that is a quick overview of Module 3.